Your finger is hovering over the close button. The position has been open for 11 minutes. It is down $43. You told yourself you would close it at minus 30. You did not close it at minus 30. Now it is minus 43 and your hand is not moving. And some part of your brain genuinely believes that if you just wait one more minute, it will come back. It does not come back. You close it at minus 61. This is not the beginning of the story. This is somewhere in the middle, the part nobody puts in the YouTube thumbnail. The beginning of the story started months ago in a much more dangerous place. It started with hope. Someone on YouTube showed you their trading account. The number was large. The process looked simple. They had a chart, a few lines drawn on it, and what appeared to be a system that produced money with the reliability of a vending machine. You watched the video twice. Then you watched 3 more. By the end of the week, you had opened a brokerage account and deposited the first amount. Not your rent money, not yet, but real money, your money. And you sat in front of a chart for the first time, feeling like you were standing at the entrance to something. That feeling was real. What it was pointing at was not. The first stage of becoming a trader is not learning to trade. It is learning that you do not know how to trade. This sounds obvious. It is not obvious at all when you are inside it, because the market will teach you this lesson in the cruelest possible way. It will let you win first. Your first trade makes money. Maybe your second one does too. The mechanism here is not skill, it is probability. In a market that moves in two directions, a new trader with no edge whatsoever will win roughly half their trades by pure chance. But the human brain is not built to interpret this correctly. 2 wins in a row feel like confirmation. They feel like evidence. Professor Daniel Kahneman, the psychologist whose work on human judgment won a Nobel Prize, spent decades documenting this exact pattern. The way the brain constructs a narrative of skill around events that are entirely random. You are not special. You are just human. And the market is very patient. The second stage is the course. You buy one, then another, then a third one that promises to reveal what the first 2 were hiding. You learn about moving averages, RSI, MACD, Fibonacci retracements, support and resistance, order flow, volume profiles, price action. You add indicators to your chart until the chart looks like a circuit board. You backtest a strategy on historical data, and the results look extraordinary. You switch to live trading, and the results look nothing like the backtest. You buy another course. Here is what nobody tells you about trading education. Most of it is not wrong exactly, but it is incomplete in a way that is more dangerous than being wrong. Knowing what an indicator is and knowing when not to use it are 2 completely different things separated by a distance that can only be crossed by losing money. The courses give you the vocabulary. The market charges you for the education. At some point, usually after a period of small losses that you are still managing to rationalize, something breaks. Not slowly, suddenly. A bad trade that you hold too long. A news event you did not see coming. A position size that was slightly too large for a market that moved slightly faster than you expected. The account drops. Not a little. Enough that you feel it somewhere below your stomach. Professors Brad Barber and Terence Odean at the University of California published a landmark study in 2000 called Trading is Hazardous to Your Wealth. They analyzed the accounts of 66,000 individual traders over 6 years. The conclusion was not gentle. The more actively individuals traded, the worse they performed. The bottom 20% of traders by activity dramatically underperformed the market. The top 20% by activity dramatically underperformed it even more. You are not a statistic yet, but you are getting closer to understanding why the statistic exists. The third stage is the psychology. This is where trading stops being about charts and starts being about you. You realize slowly, painfully, across many trades, that you already knew what to do in most of the situations where you lost money. You knew you should close the loss at 30. You knew you should not add to a losing position. You knew the trade was not good, but you took it anyway because you were bored or frustrated or trying to make back what you lost the day before. The problem was never information. The problem was execution under pressure, which is a different skill entirely and one that no course teaches because it cannot be taught in a course. It can only be learned by being wrong enough times in real conditions that your nervous system eventually stops overriding your plan. Mark Douglas spent 20 years studying this specific problem. His conclusion, laid out across years of work with professional traders, was that the markets do not create losing traders. Losing traders create losing traders. The market is simply a mirror. It reflects whatever patterns of thought and behavior you bring to it, magnified and monetized. So you start a journal. Not the kind where you write about your feelings. The kind where you record every trade, every entry, every exit, every reason, every deviation from your plan, and every result. The journal is brutal because it makes the patterns visible. You cannot argue with your own data. You cannot blame the market when the record shows you moved your stop loss 7 times in a row on losing trades and left your winners alone to expire. The journal shows you who you actually are as a trader, not who you believe yourself to be. These are rarely the same person. The fourth stage is the grind. It is the longest stage. It is the stage most people never finish. You reduce your position size until the individual trades no longer feel like anything. You make the losses small enough that losing does not trigger the emotional cascade that used to make you do irrational things. You practice not the trades themselves, but the consistency of following a plan. Any plan, even an imperfect one. Because consistency is the prerequisite for improvement, and you cannot improve what you do not do the same way twice. Months pass. The account moves sideways. Sometimes it goes up. Sometimes it goes down. Progress is not a line going up and to the right. Progress is a reduction in the size and frequency of the mistakes that use to end your sessions early. A 2019 study by researchers examining retail trader performance across Brazilian futures markets found that out of 19,723 individuals who began day trading with sufficient capital over a 5-year period, only 1,865 were still trading after 300 days. Of those, fewer than 3% were consistently profitable when measured across a full year. 3%. And these were the ones who stayed. The ones who quit are not in the data. You stay, not because you are certain it will work, not because the numbers look good, but because you have now spent enough time inside this process to understand something that the person who watched that YouTube video 11 months ago could not have understood. Trading is not a system you learn and then execute. It is a relationship you develop with uncertainty, and the development takes longer than anyone tells you, and it is never finished. And the traders who make it are not the ones with the best entries. They are the ones who built a process they can follow on the days when following it feels impossible. Your finger is hovering over the close button. The position is up. Your plan says to let it run to the target. Every instinct you have says to take the profit now before the market takes it back. You breathe. You look at your plan, you wait. This time, you wait. Not because waiting always works, but because you following your plan always matters, and you finally understand the difference between those two things. That is not the end of the story either, but it is the first moment the story starts going somewhere real. Most people who try to trade never reach this point, not because the market stopped them, because they stopped themselves. At the core stage, at the blow up stage, at the grind stage when the account was flat for 3 months and nothing seemed to be working, and the logical conclusion appeared to be that it would never work. The traders who make it are not the ones who avoided those stages. Every professional trader you will ever read about went through every single one of them. The stages are not obstacles between you and trading, they are the trading. The process of becoming someone who can execute under pressure, follow a plan when emotions argue against it, and stay consistent across months of ambiguous results. That is the actual skill. The chart patterns are just the vocabulary. You learn to walk the same way. You fell. Repeatedly. Without embarrassment, because you were too young to be embarrassed, and because falling was simply the mechanism by which walking was acquired. Trading works the same way. The losses are not evidence that you cannot do it. They are the cost of acquiring the skill. The only question is whether you are buying the education deliberately, with a small account, controlled risk, and a journal, or accidentally with too much size and no record of what went wrong. Your finger was hovering over the close button. Now it knows when to press it.